that are not based on any consistency, but conventional wisdom that really has no consistency. The reason why I say this is because I've been trading for 37 years and I use many of these techniques myself, and I saw how difficult it was to actually be profitable or at least consistent. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Ginrette. I traded through the crash of 1987 and the great bull market that followed after that. I've traded and seen just about every technique or method imaginable. I've traded through quiet markets, choppy markets, straight up, straight down markets. So I know what works in terms of consistency, and I know what doesn't. I left the floor in the mid-90s to manage money and also to pursue my own trading. And 7 years ago, I started specialist trading, where all I do is teach and mentor my students the techniques and strategies that I use myself. As I stated, we are first and foremost an educational company, and I'm going to educate you today by showing you a very simple but powerful technique for trading tops and bottoms. This is the way I apply it, and I'm going to share it with you. But please remember, this is not a full-fledged strategy. This is just an entry technique, but you can apply this technique to any strategy you currently have, and you can also build a strategy based off this. But I'm going to show you a lot of examples, chart examples, so that you'll be able to start implementing it as early as tomorrow if you'd like. But before we begin, as always, we're required to show you our disclaimer. Ask that you please take a moment to view it. I'm going to show you a lot of performance results using this entry technique for trading tops and bottoms. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So as you're taking a moment to view our disclaimer, I would also like to invite each and every one of you to follow us on Twitter. There's our handle right there. You may want to copy that. That's at SPCLSTTRADG, short abbreviation for Specialist Trading. I post information on a daily basis, anywhere from daily financial wisdom to signals that our strategies have generated. A little bit behind the fact, because those strategy signals are for the members only, but at least you know what we're in and what we're out of. So I really encourage you to follow us. There's a lot of great information there. As well, my sister site, which manages all my course promotion and selling of my techniques and courses, is Pro Trader Strategies. They've also created a Facebook page for us, so you can log on and like us on Facebook. There's a lot more detailed information about what we do and how we trade there, okay? All right, with that said, I really want to stress more than anything that we're about education. And the reason why is because of firsthand experience. My first year or two on the floor of the exchange, I struggled tremendously. I was doing all of the things that I had been taught to do. I was using conventional wisdom. I was going to all the seminars, reading all the books. There weren't any chat rooms or trading rooms then, but what there were was subscription-based newsletters, and so I was subscribing to everything, and I still couldn't get things going. In fact, I would have maybe 3 or 4 great trades, but it was always the 5th trade where I gave everything back, and I'm sure many of you are going through that right now. It's extremely discouraging and very frustrating because you just can't seem to make ends meet, and you put in a lot of hard work, a lot of time, and especially a lot of money, and you don't have anything to show for it. So I went this way almost a year and a half or so, until ultimately I was lucky enough to have a few specialists on the floor who had been trading roughly about 30 or 40 years themselves, who were able to see how much I was struggling and turn my way of trading around. These are the ones that really taught me the tips and techniques that I currently use today, and these are the things that I teach my students. In fact, this is what I'm going to be teaching you today. And what they really shared with me was that I was really overcomplicating my trading and focusing too much on conventional wisdom. And once they taught me to release those things, to simply let go of them, that's when my trading started to become consistent. So it's not about how many things you can pile onto your trading plan. It's more about how many things you can release and let go from your trading plan and keep things as simple as possible, and that's where you'll start to see more consistency in your trading. I know that's what happened with me, and that's what I teach all of my students as well. So I'm going to teach you this extremely simple, as you'll see, but powerful entry technique today for trading tops and bottoms. The last thing I just like to mention before we get into this, because this is going to be kind of a classroom setting, I realize many of you may have questions, but if you kindly wait till the end of the presentation, I promise I'll get to each and every one of them. Many times if you wait for the next slide, your question will be answered by just waiting for a few slides down the road, okay? So just wait till the end and I'll answer all the questions in the last 10 or 15 minutes. Okay, so let's start out by sharing with you how most people trade tops and bottoms. And once again, this is from first-hand experience because this is the way I used to trade tops and bottoms on the floor. And let me just start with the fact by telling you that there are a good number of people that make money trading tops and bottoms, but I'm going to share with you, firstly, how most people trade tops and bottoms, myself included. All right, let's start up with stocks for all you stock traders, and we'll go through about 2 or 3 different markets to show you different markets and time frames. Now I'm going to start off with showing you some older charts for educational purposes, but then we'll expand it and share with you some more recent charts. In fact, as recent as this morning. But let's start out with this chart in Cat Tractor. Okay, as we see, when you want to trade anything overbought or oversold, you need to have some type of overbought, oversold tool. Now, in this case, as you see here, I've just plotted your standard slow stochastic. But please, don't feel as if it has to be the slow stochastic. You do not have to do the same thing we're doing here. All we want to do is have some type of tool or indicator. It could be something that you've devised. It could be another oscillator. It could be based off the tides of the oceans. It really doesn't matter as long as it's telling you that something is overbought or oversold. Now, once again, I've just plotted your standard slow stochastic. I haven't edited or altered anything. In fact, I didn't even go into the edit box. All I did was just click it on, and it just appeared at the bottom of the page. Now, using this type of tool or whatever, what we basically see here is that we have an upward threshold, which is roughly, I believe, 80 in this case. And anytime the indicator goes above, you are in the so-called overbought territory. And anytime we are below that lower threshold, which is 20, I believe here, we are in the so-called oversold threshold. So this is the way it usually works when we're using this tool. So what you want to do is, when you go in the so-called oversold area, that's where you buy. And as we see in this example, had you purchased here, you would have a very nice trade. And then you wait for the indicator, whatever you're looking, to go into the so-called overbought territory. So as you see here, it gets in the overbought, you exit your trade, you have a nice profit, and now if you're an aggressive trader, you'll now go short. So you sell because we are overbought. And as you can see here, well, you have another good trade here. The market goes all the way down, and now we are back in the oversold territory. So using this technique, once again, you cover your short, you got a really nice profit here, and now it's time to go long. So at this point, you are now long, and guess what? This time it doesn't go up. But that's okay. You've got about 2 or 3 really profitable trades under your belt, so you decide to hold off a bit. In fact, you decide to double up. So you buy some more. In fact, you don't need it to go that much higher in order to break even or at least make back and recoup some of your losses. So you buy some more, and it goes up a little, but then it goes even lower. It doesn't give you a chance to get out. So now you triple up until ultimately it goes more, lower, and lower until finally you've given everything back that you originally made on the first couple of trades, and now everything that you had a profit in is now gone, and you're now in the loss column. Does this look familiar to anyone? This is the way I used to trade on the floor. Remember, once again, I said I usually have about 2 or 3 great trades, but on the 4th or 5th trade, I'd give everything back. Now, this doesn't just happen in stocks. We'll see this in the EMini S&P as well. Let's look at this older chart of the EMini. And as you can see here, this is a 5-minute chart. We have the same slow stochastic, but once again, please remember, it does not matter which tool you use. You can use any tool you like as long as it tells you that something is currently overbought or oversold. Now, in this 5-minute chart, we see here that we are in the so-called overbought territory. So let's say you decide to sell, and you've got a great trade. It goes down right after that. And now that the indicator is now in the oversold territory, well, you cover your short, and you buy. You go long. So you feel at this point you're probably going to retire because now you've made even better trade to the long side. You get in the so-called overbought territory, so you sell, and this time you go short again. So at this point, you really feel you're going to be retired in the next 3 or 6 months because it's just too easy. You're currently short on this 5-minute chart, but it doesn't go down. In fact, it goes a little higher, so you decide to double up, you triple up, and then finally, once again, you've given everything back you made in the first couple of trades, and you're now in the loss column. Now, this phenomenon just doesn't happen in stocks or the E-mini. We also see this in the Forex markets. In fact, we see this even more in the Forex markets because they trend so strongly. Here's an older chart of the Swiss franc. Using the same concept of overbought, oversold, regardless of what indicator you want to have or apply, we are in the so-called overbought territory. So you sell the Swiss franc, or overbought again. We never got a chance to cover our short, so you sell again. You sell again until once again you've lost everything. In fact, you never even had a profitable trade in this scenario because you were selling as it continued to go higher and higher. Now here's the trouble with this technique. It will work every once in a while until it stops working. All right? And that's when you give everything back. And remember, as I stated in the very beginning, we are an educational company that tries to instill consistency in our members and students. We're not about hitting home runs, even though we may hit a home run every once in a while. We're more about being able to teach you how to trade with consistency so that you can be trading 10, 20, 30 years down the road. And in my 37, going on 38 years of trading, I have found that there's no consistency in this conventional or standard way of picking tops and bottoms. Once again, it's like trading, or I should say, it's like gambling, or it's like playing the slot machines in Vegas. Every once in a while at the slot machines, you will get a winner that gives you this false sense of security that you've done well. But over time, if you look at it, even after all the bells and whistles, you really have nothing to show. And that's because the odds are in the favor of the house. It has actually the worst consistency record are for slot machines, but most people tend to play them. It's the same way with tops and bottoms. Everyone comes into the market wanting to pick tops and bottoms because it's just in our nature. We always want to sell at the top and exit at the bottom and then buy at the bottom. But it's just too difficult. As I stated, there are a small number of traders who are able to do this, and they do very well trading tops and bottoms. But they're probably in the 1 or 2% of all traders. All right, the rest of us, myself included, have a very difficult time trading this way. I know I did when I was trading this way on the floor. So as an educational company, we want to teach and instill something in all of our students so that the majority can understand it. We want something that's more cut and dry. Not that only 1 or 2% can get and the rest, the 98% of us, fail consistently. So here's what my mentors taught me. They saw how I was struggling trying to trade this way. They saw how difficult I was doing. And here's what they told me, and it really sunk in. And this is the mindset I want to instill in you, at least for today, if you could, please. That basically there is no such thing as overbought, oversold. All right? I know we've all been taught that. I know we've all read the books and the seminars, but you really have to grasp this if you want to be consistent in the markets. There is no such thing as overbought, oversold. We've all seen equities or issues or forex markets go as high as they want and continue to go and be in overbought territory for weeks, if not months. And we've all seen issues and futures go down lower and lower and lower and stay in oversold territory for weeks, months, sometimes even years. We've even seen equities go all the way down to zero and just go bankrupt. So it's really not in your best interest to try and stand in the way. As I stated, sure, it will work every once in a while, but it's more like playing the slot machines. It just gives you this false sense of security that you're doing all right. But over time, you really have nothing to show for it. So what we want to do is teach our traders and our students how to become consistent. So how are we going to be consistent trading tops and bottoms? Because after all, the title of this presentation is the correct way to trade tops and bottoms. Well, once I finally grasped this concept, and I really finally understood that there's no such thing as overbought, oversold, here's what my mentors taught me. He said, Steve, the right way to trade tops and bottoms is to simply go with them. All right, so what do we mean by that? How do you go with a top or a bottom? Well, here's the technique I'm going to be sharing with you today. And once again, this is just an entry technique. I know a lot of you at the very end, when we go into the question and answers, are going to say, well, Steve, where do I place my stop? Where exactly do I exit? What type of money management am I using? Am I trailing the trade? Remember, those are all part of a strategy. The pieces of the puzzle are extremely important, but I'm just going to share with you the entry technique today. In future presentations, I'll give you all that other information. All right, so here's what you need. We're looking at that same chart we looked at earlier, just for educational purposes, cat tractor. Here's the chart, and here's what my mentors taught me. They said, Steve, in order to trade anything, I don't care if you're trading a daily chart, a weekly chart, or a 5-minute chart, or a tick chart, you must always plot a 50-period moving average. And once you plot the 50-period moving average, you always ask yourself, and you may want to write this down, always ask yourself, where is price in relation to the 50-period moving average? Okay, I'll say that again so you can write it down. Where is price in relation to the 50-period moving average? Because if you ask yourself that question before you pull the trigger, you'll only come up with 2 possible scenarios. The first scenario is that price is going to be above. And if price is above, well, that means you're only going to be looking for buy setups. It does not mean you're going to buy at the market, but it means you're going to look for some type of structure that tells you to go long. And, as we see in this case, if price is below, then we're only looking for sell setups. So right off the bat, we know now that we should never have even considered picking a bottom in Cat Tractor. There's no way we would have even thought about it. We only want to be looking at this from the short point of view, from selling. So now that we know we're only looking at Cat Tractor from a seller's point of view, how are we going to initiate this entry technique? Well, we go back and use our oscillator once again. It doesn't matter what it is. Once again, it could be something that you created. It could be even something that someone tells you on TV, some guru telling you that a specific market is overbought or oversold. All we want to do is just exploit it, because we know there's no such thing as overbought or oversold. All right, it doesn't exist. So, since we're going short, we want to locate on the chart all of the so-called oversold areas, as we have here circled in red. And once we've located them, then we want to identify all of the short-term bottoms, the little pivot lows that were created, but only while we were in the so-called oversold area. And these are right here, okay? As you can see, those small, short, red horizontal lines are little lows that were created, but only while we were in the so-called oversold territory. And why do we want to identify where they are? Because we want to exploit them. Because since we know there's no such thing as oversold, if we trade 1 or 2 ticks below those levels, that's our entry point. We're going to sell. So now you see, instead of having maybe 1 or 2 winners and then giving everything back in the next 3 or 4 trades, well, now we have nothing but winners because we're in sync with the overall trend, that's a 50-period moving average, and we are exploiting the so-called oversold, overbought area, okay? Let's move on to the next example. Here's the 5-minute chart of the EMini, okay? Once again, an older chart for educational purposes. So once again, if you have any questions, remember, we'll answer them at the very end, okay? Many times your questions are answered on the next slide. All right, first thing we do, before we even pull the trigger to buy or sell, we always apply a 50-period moving average. In this case, we ask ourselves, once again, where is price in relation to the 50-period moving average? Price is above. So, if price is above, are we going to think about shorting? No, we're only going to be thinking about buying. We're going to be looking for buy structure. Once again, we're not going to simply buy at the market. We don't just simply buy, because price is above. There's no structure in that. There's no plan. We have to have some type of plan. So here's the plan. If we're looking to purchase, well, then we want to locate all of these so-called overbought areas, which are right here circled in green. Once we've found the so-called overbought areas, we want to exploit them by identifying the tops now that were created while we were in the so-called overbought territory. Why? Because we know there's no such thing as overbought, and we're going to exploit it. So once we trade 1 or 2 ticks above, there's your entry point. So now, instead of having 1 or 2 winners and then giving everything back, well, now we have nothing but winners because you're buying in sync with the overall trend and you're exploiting overbought and oversold conditions. Lastly, we can apply this once again to the Forex markets. As we've seen that this works extremely well in the Forex markets, regardless of time frame, but we're looking at daily bars here, because the Forex markets have so much capital, so much money and funds behind them, they trend tremendously. So once you know what side of the market to be on, by applying the 50-period moving average, you just simply go with it. So obviously before we had tried to short the Swiss franc all the way up, and we had nothing but losing trades. Well, we're always taught you short because things are overbought, right? It can't be overbought for long. Well, as we see here, the Swiss franc was overbought the entire time frame of this chart, okay, of this slide. So, once again, there's no such thing as overbought or oversold. It really is a gambling mentality to try and stand in the way of a strong trend. So, if price is above, what are we going to do? We're only going to be buyers. All right, so see how simple this is. We automatically know what side of the market to be on. So if we're going to be buyers, well, then we simply locate all the overbought territory. There's no such thing as overbought, so we're going to exploit it by identifying all the tops that were created while we were in the so-called overbought area. And then once we trade 1 or 2 pips above, that's your entry. And now before, we had nothing but losing trades because we kept shorting the Swiss franc the entire way up. Now we have nothing but winning trades because we're in sync with the overall trend using the 50-period moving average, and we're exploiting so-called overbought overbought conditions. Remember, as my mentors taught me, there's no such thing as overbought, oversold. It will work every once in a while, but over time, there really is no consistency to it. It took me a very long time to grasp that concept because I was like everyone else. I'd always been taught, oh, this is too high. Oh, it's never been this high before. It's gone up too soon. It's gone up too quick. There's some resistance level here, or some earnings are going to come out and it's going to go down lower, and it would never work. Maybe once or twice it would work, but then inevitably I'd give everything back. Same thing with the downside. I would say, oh no, we're at major support. We've got to hold here, but it wouldn't hold. And then it'd go down lower and say, well, we're at some Fibonacci level. Wouldn't hold. And we were oversold the entire way, all the way down. So it's much easier to be in sync with the market as it is to try and pick places where it's going to stop. All right, so let's look at some more recent examples going back a couple of months and, in fact, going back even just a few hours ago. Let's look at stocks now. Start off with stocks for all you stock traders. And we'll start off with this first slide here. This is in Archer Daniels. As we see coming into April, into the end of May, where were we in terms of the 50-period moving average? Well, we were above. So this is telling us that from April on into May, we're only going to be buyers. We're going to be exploiting so-called overbought conditions. So this would mean we locate the areas where we're so-called overbought. Once we've done that, we identify the tops, and all you have to do is simply jump in to buy. Your first buy, you see, would have been, you could have, many times you'll see that the very first buy is often the best, and that's where you get the most bang for your buck, so to say, by getting in early. If we look at the next slide here, all right, we see here that we are well above the 50-period moving average, once again, an LYB. This is all the way into April, coming into the mid-May. So what does this tell us? It tells us we're only going to be buyers. We're not in any way going to consider selling this. Sure, it's got to top out every once in a while, but remember, we're about finding consistency. We're not about trying to pick tops and bottoms. That will work every once in a while, but we know over time we won't have any consistency. So I'm not going to sit here and tell you that, tops and bottoms techniques won't work every once in a while. As I stated, they do. But there's only 1 or 2% of most traders are able to do that. The rest of us have a very difficult time. So we're more interested in being consistent, and the first thing we do is look and identify where price is in relation to the 50. As we see here, price is above, so this tells us we're only looking to go long. We locate the overbought conditions, as we see here, and then we simply identify all the tops. And once we know that we trade 1 or 2 ticks above, that's your entry point. Here's another example now to go short, as we see here in Triple L. Coming into, I believe, in March, middle March, all the way up until May, we were below the 50-period moving average. So what is this telling us? It tells us we are in no way going to consider buying Triple L. We're only going to consider going long. So if this is the case, well, then we simply want to locate all the so-called oversold conditions, because we know there's no such thing as oversold. Once we've done that, we identify the bottoms that were created, the short-term bottoms, remember. As you see here, here's where the short-term bottoms were created in the so-called oversold. We only want to locate those. Here are some bottoms that were created as well, but they were not created in oversold conditions. Remember, we're trying to exploit oversold because we know that most of the time people will go scrambling once those levels are broken. So you simply sell once you trade 1 or 2 ticks below. Remember, once again, this is an entry technique. I know a lot of you are saying, well, where do I exit? Where do I place a stop? Where do I apply my money management? That's all included in our courses as well. All right, POM, as we see here, this is easy one. Why? Because we're, for all intents and purposes, below the 50-period moving average the entire time. So would we want to buy this issue? No. We're only going to look to sell it. Why? Because we want to be in sync with the overall market. So if we're only looking to sell, the first thing we do is locate the so-called oversold areas right here. That's where we're below or we are so-called oversold according to whatever tool we decide to use. Remember, I'm using the slow stochastic. It does not matter what tool you use. It does not matter if you use another oscillator. It does not matter if you use something you created. It does not matter if you just listen to someone on TV or even looking at the phases of the moon. It doesn't matter. Whatever something is telling you is overbought or oversold, we're going to exploit it. So we identify all of the bottoms that were created, and that's where your selling point should be. All right, ABY. Now this is where it gets a little difficult for beginning students of mine, because they say, well, Steve, we're above the 50, then we go back below it, then we go back above it. So how do I know what to do? Remember, just because price is above or below the 50 does not tell us we're going to enter into a trade. That's only telling us what side of the market to be on. Once we are consecutively closing above or below, then we have to look for those setups. So as we see here, even if we're above or below crossing back and forth, we just simply look for the overbought and oversold areas. Now, once we identify the tops or bottoms that are created, we see here that a top was created in this overbought and then a bottom was created in this oversold. But once we crossed up above, we never traded below this area, so you never would have sold. So there's no reason to be scared or frightened that you would have sold and then it would have gone straight up, because we never traded below that level. So the only thing you would be doing here is going long at these levels. All right, so once we trade 1 or 2 ticks above, those are your entry points. And it's that simple. You never would have gotten short. You would have ridden it the entire way up. Okay, now we can look at a unique chart here. This doesn't happen all the time, but many times it will. You'll see that a price here, I believe this is an Amazon. We crossed up above the 50-period moving average, and we were above the entire time. Now, sometimes it takes a little longer for this technique to be working out. So as you see, we identified the so-called overbought areas. We identified all of the tops, and we realized this is an expensive stock, but you could have applied options to this. There's many ways to do this, but then as you see, once the stock really gapped up on some news or some indication, you would have been in this. The only way you really would have lost money is by trying to pick a top here. But because we are above the 50-period moving average, there was no reason to be shorting Amazon. You don't care if there was news supposed to be coming out or what was happening in the world or what was going on in the market. As long as price is above the 50, you're only going to be looking to buy. All right. Another example here, as we see, I believe this was a chart of crude oil, just to show you how this works in different markets. We're above, in this time period coming into May, it's safe to say we were above the 50-period moving average. So it's very easy to know that we're not going to try and short crude oil at all. We're only going to be looking to go long. As you can see, we identified the overbought conditions. Then we located the we identified the tops, and then you simply purchase once you trade 1 or 2 ticks above. So we've shown you daily bars and stocks. We've also shown you how this is going to apply to crude oil and commodities and futures. Let's look at the EMini S&P futures now. Now, I just want to show you how this works in different time frames, just to show you that we're not cherry picking this concept to just one particular market or time frame. If we look at a weekly chart of the EMini going back all the way to 2012, I believe, going back over 3 years, first thing we ask ourselves, remember, it doesn't matter what time frame you're trading. You always plot a 50-period moving average. Now, this is a weekly time frame right here. So what you want to do is you want to plot a 50-period moving average, and then you ask yourself, what or where is price in relation to the 50 period? Now, on a weekly time frame going all the way back to 2012, where has price been? Price has been and continues to be above the 50 period. So if you trade on this time frame, there's no way you should have been shorting the market. Now, obviously, there were a couple of places where you could have had some nice shorts, here, possibly here, but there you would have had to have been, quick, and there were, few of these opportunities. I'm sure if you had applied the same method or plan in order to trade this way, you would have had a number of losses as well. Remember, we're more about getting you to be consistent rather than hitting home runs. So you'd be much more consistent if you simply identified the so-called overbought conditions, identified the tops, and look at all the opportunities you could have had to go long. Now, we know that not everyone trades the EMini on a weekly basis, but you could have used this as a trend identifier or even as a market timing tool. Now, that's on a weekly time frame. Let's go to a smaller time frame, an hourly time frame. This was a couple of weeks ago on an hourly time frame on the continuous chart. Price closed below the 50-period moving average. Okay, so coming into this hourly time frame, where is price? Price is below. So this means we are in no way trying to pick a bottom. The only thing we're trying to do is to go with the overall trend. If the 50-period moving average tells us the overall trend, well, then we're only looking for selling opportunities. Okay, so we are and continue to be below the 50-period moving average. So what do? We locate the so-called oversold area. Then we identify the bottoms, and you can see here we only had a couple of bottoms identified, but that's okay. Once we trade one tick below, there's your entry point to go short, and in just a few days, I believe we could have had about 15 or 20 points in EMini, anywhere from $750 to $1,000 per contract, just using this simple entry technique. Remember, this is an entry technique. It's not a full-fledged strategy, so I'm sure many of you are saying, well, what's the percentage of using this? Everyone trades this differently, so there's no way to give any numbers on this. Everyone uses a different exit plan. Everyone uses a different stop placement. Everyone uses a different type of money management or contract. So this is not a system. This is simply a entry technique. You cannot systematize an entry technique. All right, so let me show you what happened this morning. Now, I was able to take a snapshot just prior to the opening and coming into the few hours before the market and once the market had opened. And we asked ourselves on this time frame here, this was a 5-minute time frame, where is price in relation to the 50-period moving average? Obviously, price was above. So we knew well before the market even had this tremendous rally today that price is above on a 5-minute time frame. There's no reason to short. The only way you would have lost money on this time frame was by trying to go short the market. Do you see how beautiful the 50-period moving average works in all markets, in all time frames? So in the first hour, you could have applied this simple technique, located the overbought conditions, the so-called overbought conditions, identified where the tops were. There were roughly about 4 coming in prior to the opening in the first hour of the day. And there you go. You could have made 10 points in 2 hours just using this simple entry technique. That's roughly about $500 per contract. Now, I was able to take this in the beginning of the morning. I'm sure you would have probably made much more if you wanted to stay in this trade longer. That's why we don't systematize anything, because many of our students like to get in and out rather quickly. Others like to stay in as long as they can, and I'm sure if had they done that today, they would have made much more than the people that just got in and out and took a quick 2 or 3 points. It's up to you. Remember, this is an educational company. We're not about telling you how to enter, how to trade. You can design this to meet your own needs. Therefore, there are no statistical numbers behind this because we teach strategies. We don't teach or trade systems. And lastly, we can look at the Forex markets here. We look at this chart, I believe, in the Australian dollar. And this is a weekly chart once again. If you look back to last year, September, October, well, price was above, and then we had consistent closes below. This was last year, almost 3/4 of a year ago. So there were consistent closes being below. So therefore, what does it tell us? It tells us on a weekly time frame, we are in no way going to be trying to buy the Australian dollar. There's no way. Why? Because price is below the 50. I just showed you how this worked on a 5-minute chart in EMini. Look how well it works on a weekly chart of the Australian dollar. Okay? So if we're only looking to go short, well, then we locate the oversold. Now, look, for the last 3/4 of a year, the Australian dollar has been in the so-called oversold territory. All right? This is why we say, and this is what my mentors taught me, there's no such thing as overbought, oversold, because things, any market, currency pairs, futures, stocks, can stay oversold or overbought as long as they want to. All right, so why should we try and have the audacity to try and hope and pray that they stop at certain levels? It's much more conducive to being consistent if you simply go with them. So since the 50-period moving average is a great tool, it's telling us what side of the market to be on, well, then we simply look to go short. All right, so once we've located the oversold area, we identify where those short-term lows are, and then look how easy it is. You have nothing but winning trades going short the Australian dollar. Okay? Now that's on a weekly time frame. We want to go on an hourly time frame. This is a couple of weeks ago in the British pound. All right, the British pound is above its 50-period moving average. Very safe to say on this hourly time frame. So you know right off the bat that there's no way you're even going to consider on an hourly time frame shorting the British pound. All we're going to be trying to do is to look for buy setups. So if we're looking for buy setups using the technique I'm teaching you today, well, you simply locate the overbought areas, identify the tops, and look how simple it is to be in sync and to have consistency in your trading. Now, 2 points to remember before we go into question and answers. It's extremely important. These are what my mentors taught me, and this is what I share with all of my students. First, most importantly, you must grasp this mindset if you want to use this technique. All right, and if you really want to get on that road to consistency, you really have to grasp this and believe it, that there's no such thing as overbought, oversold. In fact, go back and look at a number of markets, different time frames, different issues, different currency pairs, different futures markets. It doesn't matter if it's commodities or stocks or Forex markets, it doesn't matter. And go see how well overbought and oversold tools have helped. Many times they will work. As I said, there are a number of traders who do well, but they are in the minority. Most of the time, things will be overbought for long periods of time and oversold for long periods of time. So it's very difficult to try and pinpoint and fine-tune where they're going to end. There are some people that are able to do this, and they're very good at it. But for the majority of us, myself included, it's extremely difficult. So it's much easier to be in sync with the overall trend. And the first thing you have to realize is there is no such thing as overbought, oversold. If you want to grasp this mindset, if you really want to trade this way, well then, never ever try to pick tops and bottoms. That's the final thing. Because, as I stated, it's very similar to gambling in Las Vegas and playing the slot machines. Every once in a while, you will get winner on the slot machines, and it'll make you think like, hey, I'm doing pretty good. The bells and whistles went off. I hear the coin coming down. But over time, you're really not going to have anything to show for it. There's really no consistency in that. In the same way with picking tops and bottoms. So if you're going to grasp this mindset and use this technique, you should never ever try to pick a top or bottom in the conventional way that we've been taught. Trust me, I'm not saying this to be arrogant or condescending. I'm saying this from first-hand experience. I didn't think there was going to be much longer for me to be a trader on the floor because I was using this standard conventional wisdom technique, and I had nothing to show for it after a year and a half, almost 2 years. So I'm saying this from first-hand experience from someone who was there on the floor who just couldn't seem to get things going. It was treading water for the better part of 2 years. Okay, so as we go into the closing portion here, I want you to ask yourself, and ask yourself honestly, do you think any of these edges that I just presented to you today could have helped your trading this past year? Now, I realize that many of you are stuck in the way you want to trade, and that's fine. I'm not trying to convert anyone and tell you that what you've been doing is wrong, and I realize that this is not your cup of tea, or you just don't want to change and you don't want to think outside your box, so that's fine. It's not my goal to convert anyone. I'm more of an educator and a teacher rather than someone telling you that you have to change totally and change your whole way of trading. But for those of you who are attracted to this, who kind of see a little light at the end of the tunnel, do you think it could have helped you at all? Let's say this is not your cup of tea in terms of trading. Let's say you don't like to pick tops or bottoms anyway, or you don't want to enter this way. Well, what if you would just use the standard 50-period moving average technique, telling you what side of the market to be on? In fact, as we look once again at this chart of Amazon, someone looking at this just on a static chart would have said, well, Steve, after everything I've been taught and what I've learned in my years of trading, there's no range here. There's no trend here. There's just a range. There's nothing I should be looking for because price is just oscillating between up and down in a range and a pattern. So I'm going to stay out of this because it's more of a whipsaw type of scenario. Well, according to what we taught you today, that's not true. If you apply the 50-period moving average, you ask yourself, where is price in relation to that 50 period? And the entire time, price has been above. So actually, there actually is a trend. The overall trend is up. So even if you didn't want to use this technique, we would strongly advise you that you should not short Amazon. The only thing you should be looking for are buy setups. It could be any setup. It doesn't have to be one of mine. It could be something that you got from Cyber Trading University. It could be something that you've got from another educator or something you've devised yourself. But either way, look what would have happened. See, this is the beauty of this simple technique that is yours for free. You don't have to purchase anything to be able to plot a 50-period simple moving average. It's always on any charting platform, and you can see this whenever you like. So do you think that at least could have helped you? In fact, I can almost guarantee if you go back and look at your last 10 or 20 trades, I can almost guarantee that the reason why you had losers was because you were out of sync with this simple technique. In fact, I dare you to go back and look at your last trades and see if your longs were below the 50 and your shorts were above. Most often you wouldn't have very much consistency trading that way. But that's the way the majority of traders trade, myself included, before I learned this simple technique. So, in closing, I would like to just extend an offer to each and every one of you to become a member of mine by joining our Secrets of a Stock Exchange Specialist training session. What this is a 3-hour video seminar. I was asked to speak a couple of years ago in Denver at a conference where I spoke in front of a couple of hundred people, and I spoke for 3 hours and gave a lot of different techniques and a lot of different more edges, similar to what I share with you today, but entirely different. This is our Secrets of a Stock Exchange Specialist training session. So you have a 3-hour video session where I not only tell you more high probability edges, I also go into detail by sharing with you and having you identify what the #1 chart pattern is that you should be looking for regardless of what strategy you're trading. You should be looking for this in any technique, in any method. I also go into detail telling you which indicators not to use. But I think the most important thing of this 3-hour video is I give you all of the rules, the complete entry, exit, stop placement, money management rules to probably our most consistent pullback strategy, and that's strategy #1. All right, before, which today all I gave you was an entry technique. What I'm going to be sharing with you in this 3-hour video is all the rules. In fact, let me show you some of the signals that our members of strategy #1 course were able to take according to the rules of this. As you see, this is a pullback technique. Many times you'll see prices either going sideways or dropping low, and you are able to purchase the stock at a much lower level before it takes off. See, it's completely different from the technique I shared with you today, where we're looking more for a breakout to the upside. This is a pullback in a trend. It works to the downside as well, okay? You'll see here that we were in a full-fledged downtrend, and every time we had these pauses or small little bounces, strategy #1 generated a sell signal. Every time we bounced up again, instead of thinking that the trend had ended and we were going higher, the strategy generated another sell signal, okay? So it works if you're going long and or short. It also works in other markets, okay? Here's the EMini S&P. We can see this. These were all buy signals using this technique. Every time you had a sell-off, the strategy generated a buy signal. And that, I believe, is on a daily chart. You can also apply this to the currency pairs. Here's the British pound. We had a sell signal here on the 6th of April, and then as the British pound started to take off, rather than people thinking we topped out, guess what? We got a buy signal right at the very bottom here at the beginning of May. So this is a great technique for trading pullbacks, completely different and separate from the technique I share with you today. Plus, I share all of the rules, all right? It's not just an entry rule which I share with you today. I share with you the entry, stop placement, money management, and exit. Everything in this 3 hours of trading techniques plus a full-fledged strategy. Now, as I stated earlier, our sister site, Pro Trader Strategies, they market and promote all of my courses and all of my different seminars. They have this 3-hour Stock Exchange, Secrets of a Stock Exchange Specialist video seminar marketed on their site for close to $1,000. But because of our association with Cyber Trading University, we've dropped the price down to $37. So you can get this 3-hour video with all the rules to the one of our most consistent pullback strategies, as well as 3 hours of more high probability trading edges, access to my personal email so that you can contact me whenever you'd like, all for only $37. But this is for a limited time only, and this is just for all the attendees today. So here's how to access that. I believe they have posted the information on the bottom window. That I believe, yes, Denise has posted the link there, as you see, and thank you very much, Denise, for posting that. Here's the information on the screen. If you'd like to contact Pro Trader Strategies, here's their website, and here you can contact and speak to any one of their trading consultants, trading at protraderstrategies.com. Call them directly at 310-598-6677. And here's the link, once again, that will take you directly to that $37 webinar offer, or that $37 Secrets of a Stock Exchange seminar. Once again, this is for a limited time only. This is just a link to a 3-hour video. So a lot of people are always concerned about, well, is something going to be sent to me in the mail? Are they discs or a DVD? No, this is, we will provide you with a link, and you will see a high quality video that's yours to keep. As well, this is not something that expires after a couple of months or a couple of weeks even. This is yours for life. So once you purchase it, it's yours. So you can access this whenever you'd like. And you always have the rules to the strategy. And in addition to this, you're always going to be a member of mine. So you can access my email and contact me whenever you like with a question. Anytime you have some questions about anything or any trading idea, you can contact me. So there's the information. I'll leave that up there on the screen. And I want to just say, firstly, I appreciate you holding off on any questions. So I'll wait right now. Let me go to the page to open up there to answer any question that you may have. Gary is asking, was this webinar recorded? Yes, I believe it was, but you probably have to check either with Jesse or Janice just to make sure. Once again, this $37 offer is a download. They send you a link, and that's all you have to do. And so it's a video that is sent to you. There's nothing that has to be shipped. In fact, you can get it ASAP. And so with the $37. In fact, I don't think you can get this much jam-packed information for such an inexpensive price. So I strongly suggest you take advantage of it. The people who came to see me speak spent some good money for the 3 hours that I spoke live, but you're getting all the same information for only $37. Stephen asks, this is similar to other counter trend moves that get back in the direction of the main trend by looking for a candlestick pattern like an engulfing one or some change in stochastics. Thoughts? Stephen, I don't know what you're talking about in terms of, is your question regarding the pullback strategy? I'm not really sure, because this pullback strategy is based off of a proprietary indicator. So it's not based off candlesticks, and it's not based off of any type of stochastics. It's based off of an indicator that we use. It's not the 50 period. It's an entirely different one that helps us to define the trend. And through that, we find out where our entry is going to be, where our stop placement is, and where our exit is going to be. Okay? Gary says, I bought it and passed me, and it was great. Buy and you will learn a lot. Thank you, Gary. I appreciate it. I hope you have. And once again, I know everyone has different ideas of what they feel trading should be and what it isn't. And even if you got the information, you said, well, there was a lot of stuff to learn here. It's not my cup of tea, but I really don't think you can beat that price. I mean, I can almost imagine that most of you spent more than $37 today just trading. So it's a great price for all the information included. And it's yours to keep. There's nothing that's going to be, disintegrating in 2 weeks. There's nothing where it stops working. And also, you're also a member of mine. You can contact me whenever you'd like. Thank you, Ashley. She says the common sense approach. Well, once again, as I stated in the opening of this, Ashley, it's my opinion over 37 years that the reason why most traders fail is because we overcomplicate our trading. It's really our own selves who get in the way of our trading. In fact, my mentors said this to me when they saw how much I was struggling. They said, Steve, it is the easiest thing in the world to overcomplicate your trading. Anyone can do that, whether you've been trading for 30 years or for 30 minutes. Anyone can pile more and more things onto their trading plan, and they think that it gives it more validity. They think that you will be more successful with the more things you're watching. But in actuality, it's the opposite. The simpler your techniques are, the less rules you have, in my opinion, that's where I've seen you have more validity to being consistent and successful. So what they taught me is that it's very easy to complicate your trading, but it's extremely difficult to simplify. But once you do that, I really feel strongly that you'll get on that road to consistency, which is what we try to instill in all of our members. Michael is asking, what is the difference between the 37 offer and the 1995? Well, the 1995, I believe on Amazon, is just a book, and it's more of a book about my experiences on the floor. It's an interesting book, but the 37 is an actual seminar that I spoke at. The book is just really my experiences of how I traded through the crash of 1987. Okay, so they're two entirely different things. If you want more information, the $37 deal gives you 3 hours of tons of information. That's that we don't cover at all. Okay. Humphrey says, yeah, boy, if you had had this information earlier, you would have made a lot on Apple. Yes. Here's the one thing I want to say. I know a lot of people, your eyes are going to light up. And you're going to say, boy, oh my God, I've discovered the Holy Grail. This is too easy. Please, this is just an entry technique. In order to be, consistent, you still need the other pieces of the puzzle. You need to know where to place your stop, because I'm not going to sit here and tell you that every setup works. You're going to have losers. You're going to have small losses from time to time. So in order to be, in that consistent mode, you have to have the other pieces, which are, you have to have stop placement. You have to know where to exit. It looks great on paper, but once you're in the game, where do you exit? Where do you move your stop to break even? And we supply a lot of this information in the $37 course. So if you're going to use what I taught you today, please, I would suggest strongly to paper trade this for a while. Don't just jump in and think that, it's free money, because there will be small losses from time to time. So you have to be very careful in implementing this until you really understand the process. Even our members who spend hundreds of dollars for our courses, which are entirely different courses, we always suggest them to paper trade in the beginning. You know, we don't just say, go out and start trading tomorrow. We always want you to paper trade, and once you really understand the process, then start trading with very small amounts, whether it's small, mini lots, or whether it's just, very small odd lots in stocks, okay? Any more questions before we get to the end here? Once again, I want to really thank Cyber Trading University for giving me the opportunity to speak and to be able to speak to all of you as well. That $37 deal is only going to be lasting, I believe, for a day or two. Once again, that's advertised. If you go on Pro Trader Strategies website, they advertise that for $997. So please, if you're going to be taking advantage of that, you must do that soon, and I'm sure you're going to get a lot out of it. Okay? All right, in closing, I want to thank you so much for attending today. I want to thank once again Cyber Trading University for giving me the opportunity to speak. Thank you to Denise and to Jesse for helping me out, setting up my presentation here. As I stated, it seems like I have to be retrained every time I use this platform, but thank you. And I look forward to each and every one of you becoming students and members of mine at Specialist Trading, okay? Thank you so much. I'll see you next time. Bye-bye.